Pelorus Group. Please, super excited to have you on board.
Pelorus Equity Group is a asset-based value-add bridge lender. A value-add lender means that a portion of the loan, if it was $1 million, is being held back for a pre-approved budget to go back into the property. Could be ground-up construction, could be tenant improvements, whatever it might be, but that's going to improve our property. So that's the specialty lending that we do. We've originated more than 5,000 transactions for over $1 billion. We're one of the most proficient at doing it. We've been through multiple economic cycles and real estate crashes, and we've successfully went through all those markets. So that's where Pelorus comes from. And just to share a little bit about how we got to cannabis, which I think is important as well, is we were getting our investors 11, 12% on things that we were doing. And our competitors started bringing in a lot of capital, billions of dollars at a time. And they pushed those yields down from the low teens or low double digits into the mid to high single digits. And in addition to that, they increased the loan to values from what we traditionally consider 60 to 65%, the max that we're comfortable with. They started pushing that to 70, 75%, 80%, and even 90% on purchase transactions. And there was no change to the quality of sponsor. So we've kind of backed away from that, and we were looking for the next cycle to come through with waves of those transactions potentially foreclosing. Ironically, all this capital flooding into the market has sustained that market, and that may or may not be the case for quite some time because of some of the things Hermes has spoken about. But regardless, we just didn't feel comfortable waiting for that to happen if it does. And so we started looking at other asset classes, and there was a law that was passed in 2014 called the Rohrbacher Blumenar Amendment. This was an amendment passed by Congress that defunded the Department of Justice from prosecuting any cannabis-related business in a medically licensed state. This safe harbor protection gave us the comfortability that we felt comfortable using our expertise in lending in this asset class and having the protection that there's no possibility that the feds could prosecute the tenant and thus extinguish our potential income source for our borrower. So once that amendment was passed, we started really taking a deep dive and looking at this asset class. And one of the things that we realized quickly into it is that cannabis use properties typically generate 10 to 15 times the income from the tenant as a traditional tenant. That is significant. And with our expertise in value-add bridge lending, we've been able to refine our processes to reimburse a borrower for the fund control draw to pull down on that budget to be reimbursed from the improvements that they've made, that we've gotten that down to 1 to 3 days. That's so significant in this industry because our best-in-class peers are 3 to 5 days, and that may not sound like a big difference between 1 and 3 days and 4 to 5 days, but let's just call it 1 day delta between those two. We're typically processing 50 to 100 draws per transaction. And if let's just say that we processed 60 draws for a borrower, and let's just say that we only saved them 1 day per draw, that's 2 months. 2 months of time was saved by utilizing our high performance capital as opposed to our next closest peer. This facility, they had spent $20 million acquiring it, and they had already started producing from this facility. Our improvements for the capital that we were providing, we did a $13 million loan for 16% rate. Those improvements that we were going to put into that building should generate an additional $5 million per month. So if you take 5 million times 2, that's $10 million. In this particular transaction, this borrower could have gone to more lower cost capital, but they weren't able to process the draws as quickly as us. Just for easy numbers, let's just say they were able to get that at 6, which doesn't exist, but it kind of exacerbates the example I'm going to use. If you take 6 minus 16, that's 10%. If you take 10% of the loan amount, 13 million, that's 1.3 million. That's the premium that they were paying for our loan, for our high performance capital. If we just save them just over a week, they're in the money. So this is one of the reasons that so many people come to Pelorus for our capital, to give an example of why we've become the leader in the industry for this asset class. So we finance the construction opportunities, like I just mentioned. We allow our investors to share in these opportunities with us. We're structured as a private mortgage REIT, which passes along some tax savings. I'll go into that a little bit later. Our example of our targeted yield is 15%, and we make monthly distributions. Our team for our cannabis underwriting and the principals of the company is myself, our CEO, Dan, and Travis Goad, another managing partner. We've got quite an extensive background between the three of us in this industry, and we've emerged as if not the leader, one of the most experienced lenders in the sector. By the way, we've closed over 150 million in transactions, which equates to 48 transactions. We're about to close on another 50 million this month. So in this asset class, being in cannabis requires a specialty use properties. These properties are significantly more expensive to build. They require extensive power, water, all kinds of requirements, and the property owners are willing to pay a premium for the value add financing. I would like to show this slide. This is a really important one. We really debated internally whether we would ever share this information, and we decided that it's too important to not let people know that we're doing it. And what it is that Pelorus, because there was no hedge fund or there was no active lender lending to the space that would take the time to make the investment to understand the real estate market, the universe of all transactions, we did. And so what this little graph here is showing you is that in each state, we've identified how many cannabis operators are in existence. For example, in California, there's 9,600. Of those, how many of them are unique? There's 6,000 of those are unique. That means that the other 3,600 that make up the 6,000 plus the 3,600 are ones that the same guy owns more than one license. And we've identified every single one of those operator license where they are located in the state. And the state only provides GPS locations. They don't give the exact address. We've actually taken all that data. We've identified what property it actually matches up with. Once we identified what property that matches up with, we've gone ahead and taken additional information, whether we did the loan or not. Obviously, we didn't do all those loans. And we understand what the size of the market is for each license type, whether it's a retailer, distributor, outdoor, cultivation, indoor, manufacturer, whatever it might be. We know what is the total universe of all operators and what their real estate is that they are either the tenant in or owner user in throughout the entire state. And so we can tell you that the market in California is about a $12 billion market. We actually know what the capacity is for all that real estate to produce for each type of those license. So we were the first ones to analyze this and utilize it in our underwriting. This is an interactive data scientist that puts this all together for us, and it stays active for each of the states we lend in. And it's one of the most important tools that we are looking at to understand what's the price per square foot for properties average in this particular county or city? What's the cost to produce the buildings? What's equipment cost here? Are there any foreclosures? Is there any referendums going through in the city adjacent to us that we need to know about that could impact our value for our tenant's lease or the value of our properties? All of these things we were tracking. And normally in a fully mature market, some hedge fund would have done this, but nobody had done it because nobody was actively lending in it except for us. We had to do it ourselves. This is a case study here of comparing the traditional lenders out there. Most average bridge lenders are processing draws in 7 days, which is, the average out there. I use 3 to 5 because that's kind of the best in class operators, just to make the example even more tighter. So in this particular slide, what we're showing is that even if your capital was, and I don't know if you can see my my mouse here, but even if the capital was only a 10% rate and ours is 16%, our capital is actually less expensive if it takes them 7 days to process each draw as opposed to our 3 days. So it's significant to our borrowers. These are for our investors. The reason we talk about all this stuff is that this is what makes Pelorus the most attractive lender in the entire space out there. in each place that we're making a loan, we want to know, have we reached market saturation yet in this particular license type? Are there too many indoor cultivation? Is the production of this, adding this property, going to now be a saturation of the market? How do we know that? And we look at that. I just want to give an example of the benefits of of our structure compared to other structures. We were the first no-cost fund in this asset class, and when I say no cost, the way we get to no cost is because we have revenue alignment and ultra low fees. Our fee to our investors is just 1% per year, and we share more than that 1% cost from the points that the borrower pays us. On average, the borrowers are paying us 5 to 6 points. So 25% is what we share of the points. So 25% of 6 points is 1.5. 1.5 points is more than 1 point. You're in the money. So from day one, you're already a no-cost fund. In addition to sharing the origination fee, 25% of that, we share 75% of extension fees or exit fees. We share 50% of profits. Profits would be if we had something that generated income from profits. That might be from exercising options for warrants that we might have in a transaction or something like that. And we also distribute 100% of all net income to our investors. This is an enormous difference in most funds. Most funds have a 20% hurdle or 20% interest carry to the manager after you reach a certain hurdle. We do not have a preferential rate that we give out. We give 100% of all net income. And by the way, just to give you an example, we've achieved 15% in the last 2 years net IRR. You know, our lending processes, sourcing, pre-screenings, we review the submission package, underwriting. We order our own appraisals for MAI appraisers. We have the construction budget reviewed by a third party and have a feasibility review. And we continue to monitor that project ongoing all the way through the process. By the way, our transactions are typically an 18-month term, interest only. We see more deals than anybody in the sector. We've been in the industry as the only solely focused cannabis lender since 2016, and we've earned in the cannabis borrower community our reputation. We have a 100% close ratio, and that is really, really important because it doesn't matter what your pricing is of your deal. If you don't close, it doesn't matter. And I'll give you a quick example. We closed on a transaction in Michigan on 8 Mile for a 300 plus 1,000 square foot strip mall that was converted to cannabis use. That guy got it under contract for $5 million to buy that shuttered property. He got it re-entitled. He got it approved for cannabis. And the day after he closed for a $5 million purchase price, he got a $35 million offer and he turned it down. That's the type of revenue that these facilities can generate. When you turn down $35 million, you would have $30 million net profit on that if you wanted to go forward on that. Let's see here. So we have a rigorous credit policy, and we manage our risk by making sure that the borrower has a very high contribution, what we call skin in the game, into the assets from prior to us even originating. It's a minimum of 25% from their side. We're actually running at about 53% loan to cost ratio, which means that 47% is coming from their side. That's really, really, really high. Traditional lending is down to 10 to 15% minimum required from a borrower. A couple of other things. So we also get full recourse personal and corporate guarantees from the borrowers. We tie up the cannabis license and pledge as collateral, but we don't give any value to that. The borrowers must maintain being current on their payments, taxes, insurance, and license. We get default share pledges from the borrowing entity, so that in the event that they were to file a bankruptcy, we could avoid the entire process and take control of that company if we so chose. We're able to get these things because no other lender exists in this space. We are able to get things that you would not traditionally be able to get in a traditional lending world. This just shows the disparity between how superior cannabis is as a specialty use property comparative when you look at the cap rates down below to the other asset classes, which are some of the most sought after asset classes right now. So we've done 150 million. We've got 50 million going out this month. That'll take us to 200 million. Our average loan value is 4.2 million. Our average loan to value is 46%. This is just the ratio that we had at the time across the country in different types of regions where we're lending at, and that's continuing to expand, and the types of property, whether it's cultivation, mixed use, laboratory, or manufacturing and distribution. Our average weighted note rate is 15.3%. 2018, we did 11.6 net IRR. That was only for part of the year. From there forward, every full year we've achieved or superseded our target yield of 15%. We believe that that will continue for many years in the future. This is a slide here on the one transactions that we have options for warrants in. So we have an $8 million loan on this property at a 14% note rate. This is a fully stabilized transaction. It was the first transaction we did this. We built this facility, and then we refinanced it after they were fully stabilized. We liked it so well. They were the first borrower that we've ever seen go profit. The tenant was able to go profitable in the first month of production. They are a co-packer of cannabis, food and beverages, hot and cold, and their largest client is the guy that did Blue Moon beer for Coors. He did a THC infused beverage, and that one product paid for the whole facility. They now, I think, have 195 SKUs, and they're probably the most efficient and largest bottling facility in the nation. The bottling line for this facility, you have to think about cannabis. To be able to have high velocity bottling lines, you have to be able to make micro dosage into each bottle at an ultra high pace, and make sure that it's not more than the 5 milligrams that it might be in each bottle. And in addition to that, you have to atomize it in such a way, because cannabis is oil based and beer is water based. You have to get a way that figure out a way, and this is actually not patent because they don't want their peers to see how they did it. They had to atomize it and make it so it has even distribution throughout the whole bottle, and it doesn't settle as well. So really interesting stuff. There's so much innovation happening in this sector. It's really fun to watch. This is just a little review of our structure. We're a Reg D 506C private mortgage REIT. Our target raise is 250 million. We only can allow for accredited investors. Our minimum investment was 100,000. During COVID, we've reduced that to 50,000. So that applies to you guys as well if you want to move forward with something. We do monthly distributions. You have the option to reinvest. We do have a warehouse line of credit for up to 20 million. The term is evergreen. Our fund liquidity is up to 20% per year. The member lockup is 1 year. Anytime you're past that lockup, you can redeem with a 30-day notification and start redeeming at least 8.33, which is 1/12 of your investment per month. And we'll accelerate that if we can. That's just what we commit to. Asset management fee is 1. There is no hurdle or pref rate, and there's no carried interest split. Our fund administrator is Amarnino. We bank with First Federal Bank of Florida, who's FDIC insured, and they're cannabis friendly. They're doing both tier 1, which is plant touching, and tier 2/3, which is ancillary, which is what we are. Legal counsel is Grassi Law Firm, who we work with for more than 20 years, and our auditor is Cohen Resnick. Well, thank you very much. We look forward to hearing from anybody, and you can reach out to Tanya, and I'm happy to speak with anybody that has any other follow-up questions, myself as well.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.